let's look at how funds are classified, the different kinds of funds based on what the funds invest in. As I mentioned earlier in this chapter, there are so many funds out there and they all invest differently. So let's take a look at the common types of funds in terms of the way funds invest. Okay. So there are lots of common stock funds out there. The assets of these funds consist of cash and common stock. Different funds have different objectives and they lay that out there. They want the investors to know what their goals or objectives are. Some funds, their goal is to try to capture capital appreciation. Buy stocks low, sell them high. Some funds try to generate high income. That's a high dividend yield. Some funds have different investment styles, such as aggressive growth or contrarian. Some funds have a different emphasis, such as a geographic area, such as a China fund, or an industry or a sector fund, such as healthcare. So these are ways that funds differ from each other. Okay? So we have balanced funds. Balanced funds are their assets consist of stocks, bonds, and cash. So they have three different asset classes: stocks, bonds, and cash. And the asset allocation of each balanced fund is different, and so you have to pay close attention to what you're buying into. Some of these funds will try to time the markets. This means they'll shift their asset allocation if they believe one market, like stocks, looks better than another market like bonds. And we're going to talk about this, I think, in Chapter 16, a chapter on equity portfolio management. We'll look at how investment managers try to add value. Okay? So please be sure to check the prospectus to determine the approach used by the funds. Check research that's done by Morningstar, primarily. Value Line and Morningstar are two of the big research companies that provide a lot of research on mutual funds. Okay? Then we have bond funds. The assets of bond funds are invested in cash and bonds, and each fund emphasizes different types of bonds. Some funds invest in government bonds, some in agency bonds, some in municipal bonds, some in corporations, and Chapter 17 covers bonds. Funds also concentrate on maturities. Some bond funds concentrate on maturities. There are three maturities. The maturities meaning the length of the term to maturity, okay, such as short-term, intermediate term, and long-term bonds. So some funds focus on short-term, some on intermediate term, and some on long-term bonds. Finally, some bond funds focus on the quality of the bonds they invest in. Some invest in AAA on one extreme, and the others specialize in junk bonds at the other extreme. Okay, so quality. So different issuers like governments and corporates, different maturities, short, medium, and long, and quality, good quality, medium quality, low quality. Okay, let's see where we're going here, through 25. All right, we have foreign funds, and there are two different kinds of foreign funds investing outside of the U.S. International funds invest in non-U.S. securities. There are no U.S.-based companies in international funds. So if you have U.S. investments and you want to add foreign investments, then you buy an international fund. Okay? Then we have global funds. There's a difference between an international fund and a global fund. A global fund includes U.S. investments. So be careful if you're trying to carefully allocate and control your assets between U.S. and international, then you will buy an international fund. Be careful buying a global fund because it also has U.S. investments. Some concentrate in a geographic area, such as Europe funds. There are regional funds, such as Europe funds. Okay? Studies, let's take a look at studies on mutual funds. Studies reveal that there is a positive relationship between investment fund objectives, what funds are trying to accomplish, their risk and their return. Their returns. So you have your objectives, your risk and returns, and these are all related to each other. Studies reveal that investment companies do a lousy job of market timing. Okay? How much to have in different markets and when. When companies start shifting money around, look out. That typically doesn't work out very well. Studies show that few funds are able to generate superior returns. Do not believe when you buy a mutual fund that you're going to beat the market benchmark. It rarely happens, folks. Sorry. Okay? Sometimes it happens, but not consistently. And so be careful. Are you getting paid for beta or alpha? Of course, you want alpha, but when you beat the market, most often it's because of beta. Okay? Studies show that past fund performance is not a good indicator of future performance. Just because a fund did well in the past doesn't mean it's going to do well in the future. In fact, just the opposite holds true. Studies show that a strategy of buying a fund that had poor performance in the recent past and selling a fund that had good performance in the recent past pays off. People do the exact opposite. When a fund does well, people pile into it, and then it goes down and people sell it. You should be doing the exact opposite. Please refer to the piece on the next slide, written by Morningstar Mutual Fund Research, that addresses this issue. Okay, so I don't want to go into great detail, but it just shows, this is an old article, but it's been updated, and you can read this article, and it just shows that a contrarian strategy of buying funds that have done poorly and selling funds that have done well had worked out much better. It worked out more often, and you had higher returns than the other way around. So take a look at that piece. All right, one way to deal with the poor performance of actively managed mutual funds, and we're going to go over in the equity portfolio management chapter next. We're going to go over the difference between active management and passive management. But let me give you a precursor on it and just say that an active manager tries to beat the market, and a passive manager tries to match the market. Poor performance of actively managed funds take a passive approach by investing in index mutual funds that mimic an index, or exchange-traded funds. We're going to go over exchange-traded funds. The fees on these two types of funds are very low. The fees are low, and that is very important. And their tax consequences, the gains and the capital gains taxes that you have to pay, are much smaller than actively managed funds, because these funds don't trade nearly as much, so they don't generate capital gains. All right, where do you get information on mutual funds? Well, the general print media, the local newspaper, the Wall Street Journal, Barron's, Forbes, Money Magazine. Okay, the internet carries all this stuff. Specialty publications, Morningstar Mutual Fund Research, Lipper Analytical, Value Line. These are independent research organizations that you can purchase. Okay, so we're going to look at the Morningstar report on the next page, and this report covers a specific fund. Okay, and Morningstar has identical reports on approximately 2,000 funds. So the next page contains a list of the items on the report that you should closely check. And so we're going to go over that. We're going to go over that in just a minute. So we're going to take a break here. Looks like I went too far, but we'll get it organized properly. All right, let's take a break.